So this piece, I had a lot of fun putting it together. I wanted to talk about simulating option PNLs because last week we kind of focused on simulating stock price PNLs. We shared a spreadsheet that was publicly available. Anybody could copy it and sort of run their own stock simulations. And so now I kind of wanted to build on that a little bit and talk about simulating options. And so today, just to kind of like introduce what we're talking about, right? So we've spent the last couple of segments at this point talking about stock price simulations, and we again shared a spreadsheet that would allow people to run their own Monte Carlo stock price simulations. And today I wanted to sort of extend that to complex option strategies. And I'm going to share a spreadsheet as well that would allow you to run your own option P&L simulations, which is kind of cool. Make sense?
Yes.
Cool. Okay, so for a little bit of background, we're going to use the same model for geometric Brownian motion for stock price dynamics as we showed in the previous segments. We'll link those in the description if you want to go check that out, get a little bit more information around where these formulas came from, sort of what's going on, behind the scenes as we're simulating stock prices using this. But what I wanted to point out sort of is that, so we're going to be using this model, but I just wanted people to remember that this is a very simple model for price dynamics, and it doesn't account for very important market phenomena, such as price discontinuity, so like earnings, for example, or those binary events, changes in volatility or volatility clustering. You can swap out which model for price that you're going to use, but just since this is an example that I wanted to show, we're using a very simple model for price dynamics. So I wanted people to sort of keep that in mind when they actually try to sort of apply it, for example, for their own trading. Make sense?
Yep.
Okay, cool. So a little bit of background of kind of what's going on. So with this formula, sort of the one that I showed on the previous slide, and some stock price parameters that you can sort of calculate from historical pricing data, you can simulate stock prices step by step over some forecasting period. So for example, this is a forecast for a stock that's currently trading at $100 over 30 trading days is what we're simulating here. Okay?
Yep.
So using this formula that we showed on this previous slide, step by step, and again, you can reference the other videos if you want to see kind of what's going on here. Step by step, we're going to be simulating, this sort of like randomly moving stock price according to the model that we talked about. If we now repeat this many, many times, we can actually do a Monte Carlo. So this is basically that simulation that we showed on the previous slide, but repeated 100 times. And that, that forecast over the next 30 days can basically be used to look at the range of possible outcomes that we can maybe experience according to, the characteristics of the stock and the pricing model that we're using to simulate the sort of like random trajectory. Make sense?
Yeah.
So this is all background. This is stuff that we've talked before. But now if we want to talk about how we would apply this to options, which is what I want to focus on today, it's actually a pretty simple process. I'm going to go through it, and then I'm going to go through the spreadsheet to show you how you can do it yourself. But to apply this method to options, there's some simple changes that you would want to make. So first of all, you'd want to find the quotes for the strategy that you want to test. So maybe you're interested in testing a strangle or short strangle, a short iron condor, maybe a put spread. You got to find the quotes, which would be for duration, strike, contract price, and implied volatility. So implied volatility index is really what we're looking for here. Once we get the quotes for the legs that we're interested in testing, then we would want to run the stock price Monte Carlo using the contract duration as the forecasting period. So if we're dealing with 30-day contracts, for example, or 45-day contracts, then that would be the duration that we want to simulate. And then we would use the implied volatility as the sort of volatility term sigma. So instead of using historical volatility, which we would use for stock price simulations, we want to use implied volatility because it's sort of a better representation of the market's forecast for volatility. So in our simulation, we would just want to swap that term out using the volatility index is what it's normally labeled as on trading platforms. Yeah?
Yes.
So, and then once we have all that stuff, and after we run the Monte Carlo stock price simulations, then for each simulated stock price, we would basically calculate the P&L for each of the legs for a given stock, and then sum across all of those different legs. And here I have the P&Ls for a long call and a long put. It's a pretty simple calculation once you have ST, which is the final stock price at the end of the simulation. You just plug in your strike price for the contract and then the price of the contract. That way you can calculate the P&L. If you're doing a short strategy, you would simply multiply this by -1. That gives you the other side of that P&L. And so basically for each step for each simulation that we run, so in this previous case, we used like 100, right? You would basically plug in the legs of the strategy you're interested in testing, calculate the P&Ls for those legs, sum across them, and that gives you your sort of simulated option strategy P&L across all of the legs of what you're interested in testing. Does that make sense?
Yep.
Okay. So I'm just going to walk through quickly exactly how to use the spreadsheet. It's very similar to what was sort of going on in the stock simulation spreadsheet, except we're changing a couple of different parameters. So basically, the first thing that you want to do is find some historical price data, end of day data for whatever asset that you're interested in testing. So here I just made up some data from 2010, I think it's like to 2011, so 1 year's worth of data. And then this is going to calculate the mu, so the expected return annualized of that underlying, which we're going to need for that calculation. And then delta t and n, we're not going to change those parameters. Those are going to get calculated from other parts of the sheet. But now what we can do if we're trying to simulate options prices, so right, the first thing that we're going to do is sort of find the quotes for the option strategy that we're interested in testing. So for here, I'm going to use 45 DTE contracts. So we're just going to assume that the duration on the contract is 45 days. We want to find the implied volatility of the underlying. So let's just say that the volatility index is around 17. So we would put that in here. And then S naught is the current price of the underlying. So, let's say that right today our underlying is trading at $108.02. We would just plug those different variables in here as to define how we're going to run our simulation. Make sense?
Yes, very good.
Okay. Now, this last box is going to be how we're going to define the Monte Carlo itself. So how many times we're going to repeat the simulation. So these variables are going to define how we're going to actually run the simulation. This is going to define how many times we're actually going to run it. So for here, I just used 200. So this is just basically repeating that process 200 times. And then this sheet is going to calculate all of that. Make sense?
Yep.
So, okay. So now here's, I think, like the cool little addition that's a little bit more specific to options. We go into the option parameter part. And now remember that I told you that you had to go fetch the quotes for the options that you were interested in testing. So for here, for example, I have a strangle. So if you have long or short, you either put, for long, it's +1, for short, it's -1. You put the price of the contract. So let's say like it's $1.25 per contract. And then you put the strike of the contract, which for example is like $104. And this is all of the different put legs that I'm going to put on my option simulation. I would do the same thing on the call side. If, for example, I wanted to test a strangle. So a short put, one short put, and one short call, I've sort of put the pricing and the strikes in here. And then this sheet's actually going to run those option simulations accordingly. Make sense?
Yes, this is amazing, Julia.
I'm actually pretty happy with this.
Yeah.
So this actually simulates. So 45 calendar days is about 33 trading days. Yep. So this is going to simulate 33 trading days in the future. So this is my stock price simulation. And then lower in this sheet, it's actually going to be calculating the PNLs for each of the legs that I defined on the previous page. And then it sums everything up. And now I have my strategy PNL. So for example, this is the strangle. So I had one put leg and one call leg, and it calculates all of that here. Let's say, for example, I want to make it a vertical spread, for example. So let's say that I have one long leg, so +1 for long. My contract price is, let's say it's $1, and my strike price is going to be 100. I just delete this call. So I just want to look at the vertical spread. And then when I go to the simulation data, it actually updates it. And now I can test my vertical spread. I can test as many legs as I want. This supports up to 10 put legs and 10 call legs, but you can really plug and play and throw in whatever you're interested. So like, let's say that I want to have, like a put spread on one side and then just a short call on the other side. It'll actually calculate those PNLs and then look at the strategy PNL based on the legs that you input. And then when you go to the analysis tab, this will actually tell you what's the pop, for example. So like this option, strategy that I have here, which is a put spread and then a short call, right? If I go to the analysis tab, this tells me the pop according to my simulation. So what is the likelihood of making at least a penny by expiration? What's the average PNL for the trade? What's the median PNL for the trade? What's the worst loss? What's the CVAR? And then you can kind of plug and play as many legs as you want. And then you can kind of see how that sort of changes here. Here's like our short histogram, for example. This kind of is where most of our occurrences are concentrated. And then you can see the tail here. And this kind of does all that stuff for you. We can test it out if you want. So for example, like we can see how close it gets to the actual platform. Give me some, okay, so the drift rate on SPY is about, let's say 9% per year. So that's pretty close. 45 days. Where's the S&P trading right now?
Let me give it to you. SPY at 567.7.
So we're let's do 567.63. 567, 63 for the S&P. Let's do 200 simulations. So we're going to keep that the same. Now let's find some option quotes. Do you want to pull up like a 16 delta strangle? Let's see what that is.
For October expiration.
Yeah, let's look at what's the DTE on that? That's like 40 through 43 days or something.
Oh, we go to the 43. Yeah, there's one for November 15, 45 days.
Oh, perfect. Let's do 45 days. So we're just going to keep that the same. So the DTE is going to be how long we're going to, how far out we're going to simulate. And then can you find some quotes for a 16 delta strangle?
Yeah, for the strangle on the put side.
Yep.
16 delta is a 527 with a 4.02 cost.
Okay, and then for the call side?
And for the call side, let me give it to you. Wait, some loading. Strike 598 and with 2.24 cost.
2.24. So okay, we have our short strangle, we have our different put PNLs, we have our call PNLs. Those just got thrown in. And then when we look at the statistics, we have pop of 77%, something like that. Average PNL per trade is about $98. Median PNL is about $626. Worst case loss is $9,000 is what the simulation tells us. The C-bar is about 2560. This, my guess, is probably not too different from what you would see on like a brokerage platform. You can really throw whatever you want in here. So if you want to look at like Tesla simulations, for example, you just take, a couple of years worth, for example, of Tesla data. This will calculate it, calculate all these parameters. You choose the DTE, like the duration of your contract. This calculates it into trading days. You take the IV, like usually this is the IV index. So if you look on the options chain, the IV index for the contract is what you would use here. And you put this as a decimal percent. You put S naught, you put the M, and then this, you put in as many legs as you want, and this will simulate it. So if you wanted to test an iron condor or a spread, or maybe you just want to throw in a bunch of legs, you can kind of do that. This supports up to 10 puts and 10 calls, so technically 20 legs.
This is so correct, Julia. The max profit's actually basically exactly with the pop, just also very similar. Everything, Julia, you got it.
Hey, there you go. But yeah, I would love to know what we think. And as well, we also, I'm going to throw this in, but we published the stock simulation sheet. So if you want to go give that like a like or a comment, we would really appreciate it, because that also helps me figure out like what sort of content to make and whether or not this is the right direction or not. So if you guys want to go give your thoughts on that video as well, would very much appreciate it.